pension, investment products for low-income households, and of course middle income. And we look at both microprudential as well as macro as well as consumer protection and stability sort of issues. So we are driven by all of these concerns, not particularly siding anyone. And I just wanted to kind of say that before we jump into this work, that I would urge you to all perhaps just browse through the Dvara website. We are interested in, like I said, a whole range of topics. We are interested in social security, something that we picked up about 2 years back, and it seemed and it has turned out to be extremely important given how the pandemic has panned out for the economy. We are interested in sort of consumer risks that digital financial services and digital non-financial services have sort of brought about in the lives of sort of retail individuals, not just low income, but particularly in relation to low income. Exclusion and sort of misuse of customer data, individual data, a lot of that brings out a lot of issues, and we are interested in all of the regulatory as well as let me say, legal aspects and what does it mean for the market and retail individuals. We are interested in all of that. And I think, as you will notice, while research is certainly something that we focus on and we use as a means, we are very much interested in the solution side of things, right? So we do want to help sort of practitioners as well as regulators, and we want to proactively come up with solutions. And therefore, you will notice that Dvara Research is both a research sort of organization that is creating evidence, but that's also advocating for specific, requirements or solutions that we take to the regulator. However, we are a private non-profit organization, and all of our positions are out there in the public. We don't sort of take on private consulting engagements, and so to that extent our primary stakeholder is really the low income household. So let me just stop there and really would look forward to all of the feedback and advice that all of the experts at Gokul Institute have for us. This is in some sense sort of step one of a much more longer term theme of interest for us, which is over-indebtedness, credit markets monitoring. What does it mean? How does it impact low income households? I think while this work began before the pandemic, it has just brought to a sharp focus the role of both sort of ex-ante credit markets monitoring and the manner in which credit is delivered, and ex-post situations where households for no fault of their own have become or felt over-indebted or could not service their loans, and therefore there is this whole personal insolvency again as a theme is becoming very important today. So really look forward to all of the advice and help that we can get. All comments are certainly welcome. Look forward to this. Thank you so much.
Thank you, Deepti. Thank you, Pranav. If it's okay, I'll just go ahead and share my screen. If I could just get a confirmation that my screen is visible and that also is audible. Okay.
Yes.
Okay. So, yeah, good afternoon, everybody. And I'd also like to thank the Gokul Institute for organizing this webinar and giving us the opportunity to present our work. So this is a report that Deepti, Dwijaraj and I have co-authored. It's called Detecting Overindebtedness While Monitoring Credit Markets. And so before I get into the actual content of the presentation, I'd like to give a little brief introduction on the Financial Systems Design Initiative is the team that we work in. And so particularly our objective is to enable complete access to suitable financial products and to enhance systemic stability and efficiency. And we believe that to have a well-functioning financial system, we need to have these three pillars, fundamental pillars of the three that you can see here. The first is high quality origination, right? So what is the function of an originator? Is that they should be able to have the customers to manage liquidity and risk in a smooth, convenient and affordable manner. And for the originators to be able to do this, they should have the sufficient and adequate risk underwriting capabilities to understand, evaluate and price the risks that the customers face, right? And it's also the responsibility of the originators to provide good financial outcomes to the customers. and the second pillar is that of risk transmission. So we think that risk should be transmitted in an orderly manner from the originators to from entities who originate the risk to some other entities who are better placed to manage that risk, right? So any such mechanism of transmission would entail having an understanding and being able to identify the different types of risks that exist in the system, and also to come up with appropriate instruments to transfer such risk, and also to develop capabilities to price such risk, right? So if we move to the third pillar, which is of risk aggregation, we envision these set of players, as we call as the risk aggregators. So we see the financial system, any well-developed financial system should have a large number of large in size and large in number and diversified financial institutions which are able to aggregate the risk which has been originated from the real system, right? So that's and coming to the guiding principles that we have in place when it comes to our work, our primary stakeholder is that of a low-income customer. So low-income customer may be either a household or an enterprise. And any points of intervention that we propose or recommend as part of our work is at several stages. One is at a policy level that the regulator has in place, sort of like a macro level policy, or it can also be at the point of interface between a provider and a customer or a distributor and a customer, right? And on the right that you have see here are the several themes that we focus on, and this particular work on credit market monitoring and also detecting overindebtedness also touches upon several of these themes. So just coming to the context of where our work has been placed, right? So if you just look at the background of retail credit markets in the country, so we've seen that there have been several pockets of regional high household over-indebtedness, right? So the biggest and most recent example is that of Assam. So Assam has seen there's been apparent over-lending in that region, but also due to several other factors like natural calamity, they've seen floods and also political unrest due to the citizenship amendment bill, etc. And also, again, a third blow that they faced is also due to the pandemic, all of which has kind of created a level of indebtedness and stress amongst the borrowers. And something similar has also happened in the other regions, right? The Karnataka also kind of a saturated market with a lot of lending, which also faced another national calamity in the form of a drought. And both of these geographies also saw significant political intervention in for example, in the Assam with the microfinance, the regulatory bill which to regulate the lenders in the region, which kind of it's an overreach into what the RBI regulates, right? Because this bill has in place several provisions which place restrictions on the amount of lending that lenders can do in that region, depending on certain categories, and also provisions restricting their collection practices, etc. So this was with respect to microfinance, right? So all of this has seen an impact on the lenders also. So you see that the collection efficiency has significantly dropped just within 1 quarter between 2019 to 20. So the DPT 0 plus DPT, days past due portion of the portfolio went from 1.5% to 10%, right? So if you look at it, if you look at the whole situation in Assam and West Bengal to an extent, a lot of there's also a lot of political unrest and headwinds that are emerging, which is also similar to the kind of situation that we saw more than a decade back in the microfinance sector in with the AP crisis. So microfinance aside, there's also been cases and instances of overlending and borrower stress with respect to the digital lending ecosystem. All of this has come to surface again due to the pandemic. With there have been instances of coercive collection practices, problematic data protection or lack of protection practices, and also inadequate assessment of repayment capacity and overlending, etc. Right? And what's more problematic about this whole thing is that what we see is often after the point of precipice has gone past, right? After there's been delinquencies is when all of this comes to light. But what we must understand is that before the household or the borrower even defaults, they go through several stages of financial distress, which doesn't even come to light. We don't even come to know of it, right? This is also another reason why even the impact of COVID-19 hasn't come to fore. We don't know of it yet. A lot of it still remains hidden. So that was it for the context of our work. And coming to just the research question, right? So what we were trying to do is, what kind of tools or what kind of practices can the regulator, the RBI, adopt to be able to monitor the health of the credit markets, and also to be able to detect over-indebtedness? And the approach that we used is first to see what kind of data or what kind of visibility does the RBI have over the credit market. And if you see who are the major lenders or providers of credits, the scheduled commercial banks and the non-banking financial companies. So what we did was analyze all 168 of their regular reporting formats that are submitted as mandated by the RBI. We also saw what kind of data is being reported to the credit information companies, and also evaluate what is the extent of visibility the RBI has over such data. So these two was with respect to credit market monitoring. But again, specifically with respect to over-indebtedness, we also studied literature on different measures of over-indebtedness, how to identify it, how to define it, how to tackle it, etc. We also looked at several other international jurisdictions to see what has been their approach in tackling over-indebtedness, and to also market credit markets, monitor credit markets on a whole, right? So we already have put out our report, so you can check on our website. And we also have a policy brief which lays out what can be the implementation approach in to be able to better tackle over-indebtedness and monitor the credit markets. So this presentation currently just lays out the insights from both of these outputs that we have, and we'll take you through those. So just coming to understanding what is over-indebtedness, right? So the first step to even have like an effective monitoring system is to be able to define it. So because only after you define it will you able to monitor it. And the point is, currently there is no commonly agreed upon definition. In fact, India doesn't even have a definition for over-indebtedness. So what I have here is a few definitions that we have across jurisdictions. So the first one is in UK. So here, if you see the definition, so it goes like, where households or UK defines an over-indebtedness as where households or individuals are in arrears on a structural basis or at a significant risk of getting into arrears on a structural basis. So the key points to note here is, one is on a structural basis, right? So the focus is not just that they're over-indebted on a temporary basis or for a short period of time, but rather that it is structural in nature. And another point to notice here is of significant risk, right? So the thing is, at any point when you lend or if a provider gives credit, there's always a risk of non-repayment or getting into arrears. But for a provider or for a regulator, for anybody to define over-indebtedness, there should be a significant risk also. So that was UK's definition. So if you look at Germany, so they define it as where households' income, in spite of a reduction of the standard of living, is insufficient to discharge all payment obligations over a long period of time. And how Peru defines it is as a level of indebtedness in the financial system that, due to its excessive nature regarding income and ability to pay, puts at risk the repayment obligations of a retail debtor. So all of these have like a little similar flavor if you think of it, but it's still not a common definition, right? So there is still variations. And what a European Commission did in a study in 2008 was to analyze what are the definitions across different jurisdictions and to come across and it studied what are the different aspects that different jurisdictions had in place for defining over-indebtedness. And while doing so, it came to the conclusion that over-indebtedness is a multi-dimensional problem, right? So there is the economic dimension that that they're not able to repay, and any definition that you have has to take into their they, I mean the household or the borrower's ability to repay. And then there's a temporal dimension, which I touched upon while discussing UK's definition, that the temporal dimension is just not just that their inability to repay is just temporary, or it's like a short event, but rather it's structural in nature. And then there's also a social dimension, which is what kind of sacrifices or what a reduction in expenses is the household undertaking to be able to meet its commitments. And this social aspect, if you see, is captured in Germany's definition. And finally, there's the psychological dimension to overindebtedness, which is the stress that the household or the borrower undergoes in order to be able to meet its commitments. So considering the various dimensions, what the European Commission did is it laid out these set of criteria, which it proposed that there should be a certain set of criteria that need to be considered for anybody to come up with a definition of overindebtedness. And the first is that what should be the unit of analysis? The unit of analysis should be at the household level, because as we've seen from practice, what happens is when there is a debt to be repaid, all of the resources are pooled at a household level and paid. The assessment should not be at ideally not be at the borrower level. And another is that you assess whether it's the lack of ability to repay is on a structural basis or a temporary basis. And for it to be able to be called overindebtedness, it should be at a structural level. And the next thing is the next criteria that should be considered is all of their expenses, all of the things that the household has to pay, whether it be borrowings on something else, on another loan or consumer credit or mortgage or anything, or is it expenses or utilities, rent, etc. All of these should be taken into consideration when you're trying to assess their ability to repay, right? So looking at these various criteria, so this is the definition that the European Commission puts forth, right, as defining overindebtedness as overindebted household as those whose existing and foreseeable resources are insufficient to meet its financial commitments without lowering its living standards, right? And this is something that's been done across the different studies who have worked on identifying and measuring overindebtedness, that identifying whether a household is overindebted or not is done at both a quantitative and a qualitative level. So quantitative would be something like checking what is the debt to income ratio of the household, right? So while this is easier to check, but also easier for a provider to comply to if it's placed as a measure, qualitative is also important, right? So this can be both perceived financial and non-financial burden. So this is something that I had alluded to a little while earlier. So before the stage of default, right? So the consumer or the borrower undergoes several kind of sacrifices or coping mechanisms to be able to repay. They can be mild, ranging from borrowing from friends, families, or informal lenders to be able to repay, or they can be a severe coping mechanism like cutting down on essential expenditure, pulling their children out of school, postponing visits to a doctor or health related. So it can vary from a mild to a severe coping mechanism. So all of these also need to be taken into account while identifying overindebted household. Right. So that was it about overindebtedness. But now, if we try to see what is a rationale for RBI to monitor indebtedness, right? So the first and foremost point is coming to overindebtedness. Any unchecked level of overindebtedness can, whether it be at like a regional level or a sectoral level, has the potential to escalate and just fracture the credit market as a whole. And this is something I've mentioned in the context in the background as well. So if you look at both Assam and Karnataka, right? So overlending has led to a lot of other factors, which is also that it led to a volatile socio-political environment. And how this kind of affects is that it acts as a deterrent to any future entrance into the credit market, right? And another point is that it also, for those who are already existing in the region, their cost of operations and increases, and so does their cost of funds. So these are the effects that the providers see. But if you look at the borrowers, so even those borrowers with a good credit history and demonstrated ability to repay, even they are would be unable to borrow or access credit at reasonable prices and terms, right? So that's how overindebtedness could affect both the providers and the borrowers, right? And another point that you see is so so there is currently significant disparity in the level of credit that's going into different economic sectors and regions across the country, right? So, and this is something that's been documented in the report in the RBI Committee on Comprehensive Financial Services for Small Businesses and Low-Income Households. So we've seen that there's like significant disparity, right? So one of these examples here is that. So, I mean, there are various measures for what is should be the optimal credit to GDP, but the currently cited measure is that there is around somewhere between 50 to 60% credit to GDP for the entire country. But then if you see, like for the first point that you see here, the credit to GDP for Maharashtra, which is excluding Mumbai, and that of Bihar is at 16%, right? And if you look at northeastern states, if you look at the median, it's much lower. And if you just look at the rural in northeast, it's very low, right? So there's a huge amount of disparity that exists, right? And so that particular CCFS report, the committee also recommended a 50% credit to GDP per district to be able to go. And the point is. And there's also an additional study which shows that that like any work that you do on allocating an optimal amount of credit to districts or to regions, you should be able to like monitor it in the first place, right? So this is a study that the Dvara research did in collaboration with the RBI regional office, where we try to assess what allocation of credit or resources and what is the productivity of that particular district, right? So what we found was that there was elasticity of credit. There are certain non-saturated geographies, that is districts, where an incremental credit gives leads to an input of more than one, right? There's a multiplier effect of an increase in the local GDP. So for any such optimal allocation of credit, or any for putting in place any policies that improve the credit penetration of the country, right? You need to be able to monitor it in the first place, right? And so all of this is aligned with sort of the RBI's focus on inclusive development and better credit penetration. So this is also reflected in the recent revisions, well, not so recent revisions to the priority sector lending guidelines, which allocate a differential weightage based on the level of credit that's going to the different districts. So the idea is to incentivize or disincentivize based on what is the extent level of credit that's going, right? So all of this work also directly speaks to another area of concern of RBI, the work on overindebtedness, that is, which is customer protection, right? So therefore, RBI's focus on customer protection is also reflected in other initiatives, like their working group on digital lending, and also the recent consultative document on microfinance regulation. So if we were to design an approach to tackle overindebtedness, how would it look like, right? So there would arise several lines of inquiry. So the very first question is that of locus of control, right? Like, who is best placed to tackle this problem? And if you think of it, overindebtedness or any indebtedness occurs at like the point of interaction. It's the provider who lends to the customer, and any indebtedness and overindebtedness happens at that stage. So while it is the provider's role to be able to adequately assess the capacity, and by that also have be able to access the data, to be able to assess the capacity. The providers themselves are not best placed to do it because they do not have the complete information, and also B, they're just what is the extent of their impact, right? They'll be locally placed, and even the largest provider cannot sufficiently tackle or address overindebtedness at the market as a whole. So it's really the regulator who has the power to set in place any macro or micro prudential policies or any such measures. So they're really the provider or the regulator in this. Sorry, the regulator is really the best place to tackle overindebtedness, right? So that's about who should do it. So if you look at the specifics or how should it be done, so there are several aspects which Dwijaraj will go into detail in the latter part of the presentation, right? So there be things like what are the data points that need to be collected to even be able to detect, overdebtedness in the first place, and also from which set of institutions should we collect? Should it be from the providers, or should it be from the credit information companies, or should it be any other external sources? And also, what should be the mode of collection? So these are all the questions that need to be answered if you're trying to tackle overindebtedness. So in our work, in our study for this, we also, like I've mentioned earlier, we looked at different international case studies. So two of those which stands out were Peru and Zambia. So Peru, if you see, their regulatory, their supervisory authority, SPS, has several regulations which are in place to address overindebtedness. So ranging from things like having counterparty credit concentration limits, not just by a single borrower, but also a type of borrower or a sector. And there's also a mandatory assessment of borrowers' repayment capacity by all entities and across all products, regardless of what type of loan product they're giving. There is this assessment is necessary to be made, right? And the providers are also required to set in place early warning indicators of overindebtedness, right? And so they do it based on their own methodology. So they take in developments in the borrower's economic situation, and also developments in the market or economy to be able to arrive at such an analysis. So that's from the regulatory level, right? But the kind of data that the regulator requires of the provider to provide is also quite detailed, right? There's multiple credit related data that provide all kinds of providers have to submit, and all of these data is aggregated and used by the regulator to prepare these multiple dashboards, right? So dashboards about sectoral analysis or geographical analysis and impending risk, etc. Right? So there's a lot of data that's submitted, and there's a lot of analysis that's also made using that data, and all of this is placed in public view. And one of these credit-related regulatory reporting requirement placed on the provider is that of the debtor creditor report, or the RCD. That it's a monthly submission that is required of the providers. So this essentially is like a bureau report of sorts. It has the debtors' credit balances, which is updated monthly. And interestingly, they also have a section or one data point called the debtors' overindebtedness condition. So every month, every provider is expected to reassess the debtor's condition and update it into the data requirement that it's placed, right? And there's a lot of other analysis also that they do, like vintage analysis, sector concentration report, borrower level income, etc., right? And another example of like a interesting or a good credit market monitoring is that of Zambia, right? So Zambia has a credit market monitoring program, which is essentially all providers are expected to submit these returns in addition to their regular returns on a quarterly level, which is purely dedicated to credit market monitoring, right? So there are many key data points, like the amount of credit disbursed per quarter, disaggregated by the borrower's type, like their income category, and also the purpose of borrowing, right? So the granularity is such that you can do a lot of cross analysis, right? So for instance, in a particular quarter, the regulator is able to see, is there a lot of credit that is dispersed to shorten your loans in that particular region, and also see that they are being used for consumption, and hence giving them a sense of what is the health of the market, right? And so they're also able to assess at a macro level what is the demand versus the supply, because they also have data points like what is the number of loan applications. So these are just like some quick points from the international case studies that we had conducted. So case studies that we had studied. So just looking at what is the status quo of the credit market in India. So if you see the true picture of over-indebtedness or the level of indebtedness rests with the borrower. So what the provider has is the visibility at the point of extension of credit. They have visibility of the income profile of the borrower and the amount of credit that they have extended, and to an extent the credit extended by other institutions, right? So this is only at the point of their disbursement. And if you look at the other party, which is the credit information companies, CICs, they have visibility of the overall credit which is extended to the borrower by different providers, but they do not have not necessarily have the income profile of the borrowers. But this information is again not available to the regulator. So that's how the current system stands, right? So and these are certain on the right side that you see some findings that were found from our work. One is that one key point is that RBI does not capture data on fresh disbursement, right? So any periodically what is the amount of disbursement is not something that RBI has privy to. Instead, it's just outstanding, like the credit outstanding amount is visible, right? And also the reporting formats, the formats are such that for smaller size loans for less than 2 lakhs, the formatting structure and the granularity is that it does not allow for a simultaneous analysis of different factors such as for smaller size loans, you can't check, okay, in this geography or against this economic activity or against this type of borrower, etc., what is the overall picture. That the current reporting formats do not allow for that analysis, right? And another key point is that the data which comes from or is required of NBFCs is also very limited. So again, a simultaneous analysis of something like the average loan outstanding or economic type or purpose of borrowing or even the geographic disbursement amount, all of this is not captured from the NBFCs, right? And this is in this is in contrast to what is being done in both Zambia and Peru, that the regulator does not have a view of what is the income level of the end borrower. And this is really the key to assessing over-indebtedness, because the amount of indebtedness should be measured against the income profile to be able to see whether they're over-indebted or not, right? And finally, as we've seen, there is no definition of over-indebtedness in the country, unlike in other jurisdictions. So going past the status quo, we have just proposed a strategy of how to address or detect over-indebtedness, right? And the first point is on just the monitoring of credit markets. And how do you do it? By putting in place certain select indicators, a framework of indicators as we call it, and which Dwijaraj will go into detail later. Is a set of data points that will allow the regulators to monitor the health of the credit markets as a whole and identify any issues if there are any. And the second is specific to being able to identify over-indebtedness or potential over-indebtedness. So this would be some form of a statistical tool or any algorithm that is in place, which could use the data from the framework of indicators to be able to assess any potential over-indebtedness, right? And the third step would be to validate what we have, right? Validate not just the analysis of over-indebtedness that we have, whether we have got it right or not, but also to validate whether even the choice of indicators that we have got is appropriate or inadequate or adequate, etc. So this sort of validation can be done through surveys or any other demand side measures. And finally, the output or the result from such an analysis or validation exercise can be used to review the framework set again to kind of have a better and more efficient set of indicators. So specific to how we came up with the framework of indicators is what we did was we developed it through a series of conversations with experts, practitioners, ex-regulators of different jurisdictions, and also a literature study of the credit market monitoring reports that several other jurisdictions have in place, like Ireland, UK, Peru, Zambia, Sri Lanka, etc. And also, so that was with respect to credit market monitoring, right? But we also want to be able to detect over-indebtedness. So for that, we also looked at literature on identifying and measuring over-indebtedness. And we've also looked at the various monitoring tools that different agencies or third parties, etc., have in place for monitoring over-indebtedness or credit market, etc. So this is the methodology that we've had in place. I'll now hand it over to Dwijaraj, who will take you through the framework in detail.
Thank you, Amulya. I hope I'm audible.
Yes.
Yes, you're audible.
Thank you. I'll be walking us through the rest of the presentation where we discuss the framework in a greater detail. I understand we are slightly running late because we were unable, there were some technical issues in the onset of the call. So apologies for rushing you through the latter half a little bit. So coming to the framework of indicators, we need to understand that credit markets in India and all over the world do not operate in a vacuum. They actually operate with the actors in the real economy and the fluctuations that are present in the real economy. Given that we understand that interactions between borrowers and providers will shape the credit market, which in turn will not only impact the outcome and the behavior of the borrowers, but also the behavior of the providers alike. Further, to effectively monitor the health of the credit markets, real economic factors must also be considered, because in certain cases, as Amulya had already mentioned, the productivity of credit can be lesser, and in certain cases, the productivity can be more. Similarly, there are other sectoral variations within the real economy that can cause or that can dictate how the credit is going to impact the individual who's taking the credit and what exactly will be her likely behavior. Therefore, apart from studying the extant features at these three levels, which are market level, borrower level, and provider level, it is also important to understand how these features have evolved over time, whether what things were in say 1990s vis-a-vis what things are right now, because that evolution gives us an insight into the trajectory of the market and not necessarily just the present situation the market is in. Finally, through administrative data, it is not very easy to estimate over-indebtedness, because over-indebtedness is a phenomenon that happens at a household level. So administrative data over here is a proxy through which we can estimate the prevalence of over-indebtedness. However, at no point of time can we be absolutely certain that this is the impact of over-indebtedness on households. Therefore, we present to you, Amulya could go to the next slide, please. Therefore, we present to you indicators at three levels, which are market level, borrower level, and provider level. Coming to the market level indicators first, these indicators would be regional credit to GDP ratios, gross GDP to be more specific in terms of the terminologies that the government of India uses, to understand the saturation of credit in a geography, and also to understand the penetration of formal credit and the productivity such credit may have. Now, it is important to understand that these indicators are not necessarily always going to be a very good predictor of over-indebtedness, because we have a twin goal in focus here. First, it is to monitor the credit markets, and second is to understand the prevalence of over-indebtedness. Now, certain indicators are more potent for one purpose than others. However, all of these indicators will inform what is the level of over-indebtedness in a geography. What we understand from these market saturation and regional credit to GDP ratios is that currently there is adequate data which is being captured by the various state ministries and from the offsite reporting by the RBI to understand what exactly is the present scenario in the credit market. Similarly, we also see that historically such data has been present. And as I mentioned earlier, the temporal component of the analysis can also be done for the market level indicators. Coming to certain specific indicators over here, if you see the last indicator that is mentioned in the infograph, which is the ratio of number of borrowers served to the number of applicants, indicators like these actually tell us whether or not credit is approved for everyone, or if there are certain people for whom credit is not approved. One would assume that in an optimally operating credit markets, there will of course be certain rejections in place. Certain people will get credit and certain people will not get credit. When we see these ratios being close to one, that is, everybody who's an applicant is at the end of the day a borrower, we can suspect that something is wrong. But does that mean it is over indebted? Of course not. For that, we need to add certain other layers of indicators. And the next layer we talk to you about is the provider level indicator. So provider level indicators provide us with a little bit more granularity on what is happening at the borrower level, since providers are more proximate to the borrower than the overall picture of what the economy looks like. So over here, we talk of indicators like rate of growth of lender's asset book, disbursement to new to credit borrower, increase in advances unaccompanied by advances into new unsaturated regions. Now we will explain to you how all of these indicators together interact and inform over indebtedness. But the idea overall is that the rate of growth of lenders' assets books or disbursement to new to credit areas together indicate what is the expected level of over indebtedness. Higher rates of, for example, renegotiation of credit contract, which is another indicator that we look at, could indicate whether or not there is distress. Because if there is a distress, we would assume that the borrower would want to go to the provider and ask for their credit contracts to be restructured. Similarly, if we monitor the provider's internal ombudsman, we can understand whether or not there is an ongoing concern that borrowers have with their providers. Such concerns can very well be operational, in which case those are not going to inform the level of over-indebtedness in the economy. But in certain cases, those concerns may very well indicate to prevalence of over-indebtedness. Finally, in case of multiple lending, when we see that one individual is given some 10 loans or 20 loans or even 5 loans in certain cases, that is often an indicator, and literature also points to that, that is often one of the closest proxies of whether or not there is over-indebtedness at the level of that borrower. Now, in order to operationalize these proposed indicators, we understand that the current offsite reporting formats need to be amended. As Amulya mentioned, there are presently several features that the regular offsite reporting, I must add, formats do not capture. And I think this is important to make a distinction over here regarding what is a regular offsite reporting format. So all of these regular offsite reporting formats are data that lenders must report to the RBI at a regular frequency. It can be quarterly, it can be monthly, it can be annually. In addition to these regular reporting formats, often there are certain ad hoc reports that the RBI seeks. So in certain cases, the RBI does have visibility over certain of these features that we just discussed. However, what we find is that those, by the virtue of the fact that they are ad hoc, they are A, not regularly collected, and B, they depend on what is the judgment of the regulator at that very moment. Therefore, it is not always amenable to a continuous reporting of the credit market. Now, we also understand that most of the indicators that we are mentioning here can presently be queried from the provider itself. However, in certain cases can also be queried from the upcoming public credit registry, a centralized credit information database that the RBI has proposed in the recent past. Coming to the next level, which is the most proximate to the borrower, which is the principal agent of focus when it comes to understanding the prevalence of over-indebtedness, we have to understand that the borrower's profile is just a corollary to that of the provider's profile. Whatever the borrower is expecting is expected to be, my mistake. Whatever a borrower is experiencing is expected to reflect on the provider's books. However, since the provider's books are at an aggregate level, it is important to understand at a more granular level what is happening at the level of the borrower. Now, to be clear, this does not mean that the RBI needs to ask about the credit profile and the financial profile of every single borrower. On the contrary, we would ideally want the borrower's profile to be aggregated at the district level, which is the geography of analysis for our case, and be reported. The indicators proposed over here are what is the average outstanding and the installments, which one in common parlance one can refer to as EMI, but in certain cases it can be a weekly repayment or a bi-weekly repayment. So what is the average outstanding and installment? What is the income profile based DSR distribution? DSR here is debt service capacity ratio, which is calculated as the surplus of the borrower's income versus her repayment obligation. And these are the three features which can ex ante provide us whether or not there is a likelihood of over indebtedness in the geography. Later on, what we see are the indicators that detect whether or not over indebtedness has occurred. So one is pre-occurrence stage. The other three would be post-occurrence stage, which would include the number of insolvency and bankruptcy cases in a region, the number and nature of complaints to RBI ombudsperson. This is similar to that of complaints to the provider's ombuds. However, these are complaints that did not get resolved at the provider's level and has been escalated to the regulator. And finally, qualitative indicators on borrower distress. This is something that we will come up to in a bit. So monitoring complaints to RBI's ombudsperson help in estimating the potential breaches in conduct obligation and other grievances of the borrowers, which in turn can highlight whether or not there is a prevalence of over-indebtedness. Qualitative indicators on debt distress is again pivotal in capturing the true level of over-indebtedness. As Amulya mentioned, that the over-indebtedness has multiple facets to it, and they do not often result at the very moment, has multiple facets to it. So one starts with over-indebtedness, and then of course it goes up all the way up to default. So although we currently record the instances of default, the intermediate stage where the borrower is experiencing over-indebtedness and is having to make many sacrifices in order to continue repayment is something we are not able to capture through administrative data. And for that, qualitative surveys and qualitative indicators are required, which will be part of a survey, and that will also form one of the crucial aspects of the validation strategy. And this is something I'll come to in a bit. So currently, if we look at these indicators, we see the data to be reported, data to be captured and reported by providers, IBBI, and the RBI. All three entities will have to report it at some level. And finally, certain select data points may be queried and captured in the upcoming PCR. Going to the next slide, this is where we discuss what we believe would be one of the key drivers of the predictive engine. We think that the debt service capacity ratio, DSR, which is defined on the slide, is one of the most important indicators that can inform about the prevalence of over-indebtedness. However, when we take this at an aggregate level of a geography, what may very easily emerge is that for low-income households, their low DSR is overshadowed by high-income households, where the amount of loan may be 10 lakhs, let's say, but the income is say 100 crores or 10 crores or 1 crore. So in those sort of circumstances, we understand that reporting an aggregate number for an entire district is not the best approach. Therefore, we propose that DSR be captured and reported to the RBI at a district level for different income slabs, so that we understand truly what is the underlying feature of the borrowers in that geography. Because otherwise, one dominant feature may overshadow a less dominant feature, like I just discussed. Coming to the next slide, how do all of these indicators play together? So over here, we are giving you an example of what things can be. So all of these are, to be clear, hypothetical examples, and we expect that these are going to be intuitive at this level. However, once an algorithm is developed to detect over-indebtedness, there's of course going to be multiple intermediary variables within that algorithm, and those discussions are something we'll leave out of the presentation as of now. So if we look at two districts, one is of Coimbatore and one is of Vellore. These are two districts in Tamil Nadu. In case of Vellore, let's say that there is a low credit debt, that is, it's an unsaturated geography. A number of financial institutions and the branches in that geography is low. Compare that with Coimbatore, where there is a high credit depth, which is a saturated geography, and the number of financial institutions and branches are very high. So what we see is that certain similar features, let's assume there are certain similar features, which is in one case, there is a low rejection rate of loans, which is 2%, and quarter-on-quarter credit growth in both the cases is 30%. However, in one case, that extension is led by 70% to new to credit customers. That means these are individuals who have not had any formal credit in the past, and they're just getting credit right now for the first time. In the other case, the same growth is not accompanied by growth into new to credit customers and also happening in a more saturated geography. One could therefore expect that the level of over-indebtedness that emerges will be different in these two geographies. In one case, which is unsaturated and people are getting access to formal credit for the first time, the distress or the level of over-indebtedness will be lower than in a case where the geography is already saturated and expansion is happening to individuals who already have some line of credit. So while this is at an intuitive level, one must understand that nobody will have the capacity to look at all of these indicators and then make intuitive sense out of them at various district levels. Therefore, these framework of indicators must act as an input feature for an algorithm that detects over-indebtedness. And at the same time, the indebtedness level, and therefore results in a classification of OI, which means that we do not always just detect over-indebtedness, yes or no, but we detect a possibility of indebtedness levels and then classify if over-indebtedness is there, yes or no. Coming to the next slide. So once the detection has happened through an algorithm, what we need to do is validate the algorithms, because every M&E tool monitoring and evaluation tool will have certain limitations and may not always capture all the features that are in the underlying section that it has to capture. So we need to go ahead and understand what has been the experience of the households. And in order to do so, we propose a set of primary surveys where we look at self-declaration on indebtedness status, experiences regarding qualitative features of over-indebtedness, and we look at the individual and households level of overview of their own financial position. Such surveys, we believe, will not only validate the algorithm, but also help in fine-tuning it. Like, for example, what should be the weightage given to a specific indicator? Similarly, we also believe that the RBI is well posed to conduct such surveys because the RBI is in the business of conducting such surveys in certain cases. For example, the consumer sentiment index or the producer sentiment index and things like that. Finally, such surveys also help in understanding the nuances of the credit markets better. Like, for example, what the Financial Conduct Authority of the United Kingdom conducts. So what it basically does is it conducts thematic surveys every 2 or 3 years to understand a specific feature of the credit economy in a specific demography. Coming to the next slide. In the end, all of these tie together. So if you look at both of these concentric circles, circle 1 to the left is of detection strategy. First, we monitor the credit markets, then we identify potential pockets of over-indebtedness, then we validate it through a survey, and we review the indicators for their performance, and so on the cycle goes on. Once we are at the stage of validating the over-indebtedness by the survey, we also understand what are the primary levers through which over-indebtedness is manifesting. Because currently, the policies are not well guided by what is the experience in the ground. The policies are the regulators' understanding, and often such policies end up distorting markets. So we need to understand the factors that are causing over-indebtedness so that we can target those factors, so that we can target those levers very easily, which will be the third stage, where we deploy strategies or develop strategies to prevent and curb over-indebtedness. And of course, then we periodically review whether or not such policies have had the desired outcome. Coming to the next slide. In the end, this would be the final slide. The Discharge Ecosystem, we believe, will have a more improved monitoring capacity at the RBI for credit markets, where we have access to more granular data and combined analysis of certain indicators would become feasible. Similarly, the unit of analysis over here will not be an individual, but a geography where manageable data volume arises. We also avoid regulatory overreach of going into the houses of every single household and understanding what their features are. And at the end of the day, because these are aggregated at a district level, certain privacy concerns are also mitigated because of the mere act of aggregation. Third, the RBI's dual mandate stands at rest. So on one hand, you have the mandate of systemic stability, and we know that over-indebtedness can lead to fractures of the financial system, as has happened in case of Andhra Pradesh, and at the same time lead to customer protection outcomes for the borrowers. Privacy concerns are mitigated because A, of the I'm sorry, of of because of the aggregation, and at the same time we can apply stringent privacy standards and anonymize users as the need may be. Finally, one major thing that we have always heard of in terms of from providers is that the cost of compliance can be very high. We think that most of the data that is already sought are captured by one form or the other, are captured by the providers, or in certain cases even reported to credit information companies. And at the same time, the RBI in the past has come up with plans for a differential approach to regulation of NBFCs, and we believe that the such approach also is in sync with the approach that we are proposing here. Therefore, we expect a minimal cost of compliance. In the end, we must also caution that this approach is not an alternative to ensuring that lenders lend suitably, that we can't always just monitor. Lenders also have to take certain steps and lend suitably. And we have in the past worked on this theme extensively. And there are multiple papers, primarily authored by Deepti on this subject, that are accessible on Dvara's website. So we believe that this is not an isolated remedy, and it is not an alternative to suitability in lending. And of course, there is a need for a more robust supervision capabilities at the RBI, which not only includes the credit markets, but also other features that are out there. With that, I would like to end the presentation and open the floor to questions, if we have any.
Thank you, both the speakers. The session has been really informative, and now I hand over the question and answer session to Dr. Bhupesh Gopal Chintamani. He is the moderator of today's session. So what we have done is we have collected questions from the participants, and also there are a couple of questions which I myself have. So I've asked these questions through Bhupesh. So over to you, Bhupesh.
Hi, can you hear me? Hello?
Yes.
Yeah, you can hear me, right? Yeah. Thank you so much, Dwijaraj and Amulya, for nice presentations. I've gone through the presentation. I have a couple of doubts also. So the thing is, like, as you mentioned about the over-indebtedness. So what is your idea about the students' loan that is provided from the banking? Like around 4 lakh loan has been already given without collateral. So and sometimes there is a inappropriate jobs they get it. So it's not able to. It's not for them. It's not able to. It's not possible to pay the payments many times. So what do you think in this COVID situation? Like how you look about this scenario, a student's loan uh, in the over-indebtedness scenario? And the second one is about, do you think that this also has a major things in the case of rising the NPA in the coming days due to this COVID disturbance for the economic structure? Uh, yeah, this was the first question. When you answer, then I can go for the second one.
Right. Amulya, if you would want to take it, I would just want to address, I think, the two aspects regarding COVID. So we understand that COVID has been an unexpected shock, and in certain cases has led to a loss of employment, and may, of course, lead to an increase in NPAs and increase in customer distress. And we believe that in certain cases, while the RBI's current approach of going ahead and allowing providers to restructure the accounts is going to be helpful, but we need to ensure that those windows are extended to an extent. and B, at the same time, it's there are certain guiding principles put in place where you go ahead and restructure the accounts that needs to get restructured. However, there are of course going to be certain cases where it will be where the distress will be so severe that no amount of restructuring can really help. So in those situations, we believe that a debt discharge would be the way to go. Currently, the Insolvency and Bankruptcy Code of India 2016 has mechanisms in place for that. However, the problem is that those mechanisms are not yet in force. So once those are notified, we believe that Part 3 of IBC will be able to provide resolution to certain cases where distress is severe. Otherwise, we believe that yes, restructuring is something that can go ahead and help distress arising out of COVID. In terms of student loans, I think Dr. Bhupesh, you rightly pointed out that there are certain cases where it does lead to distress, and this phenomena is something we believe has occurred predominantly in many developed geographies where the market for student loan is huge and is a major issue in United States. So we don't have a very specific answer to that in terms of how the policy should be designed at this stage. Because in this report, what we do is just look at the indicators that can inform the RBI about the extent of over indebtedness. And therefore, once the RBI starts understanding and at large the public starts understanding from those indicators what are the primary drivers, then I think we can comment on a better policy. At this stage, if we comment, perhaps it will be a little premature.
Okay. Okay. And the other one is like as we know, given fact about the COVID situations, and also before that there was a GST and all. So we also have seen that large number of the MSME they have already shifted to the large corporate. Okay. So how MSME report the debt in the post-COVID scenario? How you see about the over indebtedness about this scenario?
Right. I think while at this stage, like the project in specific that we're working on wouldn't really help us in commenting on that. However, if I can go ahead, what we would say is that we expect such issues to arise, and I think the government of India and multiple other state governments also acknowledge that yes, there is going to be a level of distress in the MSME sector. But we need to understand what are the primary drivers for this. Not in all cases would it be due to over indebtedness, although the result can be over indebtedness. In most cases, it's a shock to the real economy and supply and demand breaking down. So I think over indebtedness, while as a result over here, will not necessarily be the primary concern, but the concern would rather be the economic revival at this stage.
Okay. Okay. There's also a question from the participant, as you mentioned initially also that there is no common definition for the over indebtedness as such, and it's very interesting to know what is the the question is about how to handle the issue arising from the aggregations of different indicators of market, a borrower and from the provider point of view.
I'm sorry, I didn't follow the question.
The question is about how to handle the issue arising from the aggregations of different markets indicators from the borrower point of view and from the provider point of view.
So we don't think there will be major issues that come up when it comes to aggregation at these two different levels. Of course, these are competing levels, but like we discussed during the presentation, often these are corollary of one another. What the providers do will basically impact the indicators at the borrower level, and whatever the borrower's actions are will impact the indicators at the provider level. So, for example, if the provider is over lending, then we will see low DSRs and higher NPAs in case the low DSR leads to a situation of default. So I think the interactions will be interesting and will definitely be able to shed more light on what is happening in the credit markets and what is the feature, or rather what is the experience of the borrowers in the market. However, to be able to say what are the possible ways there, or rather what are the possible issues that can emerge out of it, that I think will only emerge once the data is there and the RBI is able to analyze that.
Okay. There's also two more questions from the audience about as you already discussed about, like, there is a misconception about the measurements of indebtedness. Then what are the specific measure that in your study you have used it? And the other one, the question is asked by uh, uh, Satyati Mitra something. So her question is about what can be the best way to address the issue or over indebtedness, and what can be the best way to measure it. So I think these both questions are inclined to the each other, so you can respond to them.
Right. Amulya, if you want to take the question on the definition, because Amulya
Yeah,
closely studied the definition.
Yes. Yes.
yeah. So I wouldn't say they're exactly misconceptions. It's just that it's a different a way to approach it, right? So if you recall from my presentation, I also talked about the European Commission, which did a similar study trying to see what are the different aspects that different um, jurisdictions have used. The thing is, there are different criteria that have to be in place, right? So the thing is, one common thing is everybody looks at what is the amount of repayment capacity against what is their income, and such a measure is something that Dwijaraj covers also in the borrower profile, which is the debt to debt capacity ratio, right? So if you kind of do a ratio of what is the debt obligation of the borrower upon what is the available income or surplus income that they have, right? So such a measure is like rather a simple, like a quantitative measure to assess over indebtedness. Again, I would caution against just a singular measure, because this would leave out all of the qualitative aspects regarding reduction in essential expenditure or any sacrifices that these make. Ideally, those should also be incorporated, but a simple quantitative measure would be such a debt to debt service capacity ratio. I did that answer the question?
Yeah. So yeah, Dijraj, you want to answer the second one?
If you could repeat the question, please. Sorry.
Yeah. So the question is like, what can the best way to measure for the indicators? Like,
The best way to measure the indicators that we have proposed.
that you propose and use in the your study. So
Okay. So I think perhaps like we should clarify that over here we actually did not get a chance to do the data analysis, because as Amulya mentioned, what we did was we studied what are the indicators that are currently being captured by the RBI and whether or not those indicators are sufficient. If they are not sufficient, what are the new indicators that they should adopt? So we identify that there are quite a bit of new indicators that the RBI should adopt in order to understand the credit markets better. However, the problem is that given that these indicators are currently not operational, A, the RBI does not have the information, at least from the regular offsite reporting formats, and B, it's not released to the public, of course. So given that we weren't in a situation to analyze the data, however, we do believe that once the preliminary steps of operationalizing these indicators are completed, and if the RBI releases the data in the public domain, we would be very happy to take a look at the data, analyze, and maybe detect over indebtedness. So at this stage, I'm unfortunately not able to comment on exactly what would be the optimal approach, or rather the approach we took for the data analysis. What I can, however, comment on is who would be the reporter of the data. While RBI is the person who's collecting the data, we expect that the data to be reported by various entities which are not necessarily at the borrower level. So for provider level assets, it will be the job of the provider to report. For example, when we discussed credit to GDP saturation, their trends over time, we will have state ministries which are looking, or rather estimating GDPs at the district level, will be reporting certain parts of that. So it depends on what the indicator is. In our policy brief, whose link would be there in the presentation, and we can also drop in a link perhaps in the chat. What we have done is we have looked at every single indicator. It's a little bit more detailed than the presentation, of course. We have looked at every single indicator. A, checked whether or not that is available. B, checked what is the difficulty in making it available. And C, checked who is best placed or most optimal to report it. So if you want to look at the analysis in a greater detail, those will be present in the appended Excel sheets to the report and also with the policy brief. So I think that can provide like a much more broader answer, because going into every single indicator over here might just take a lot of time.
Right. So yeah, we also would share the things which is already available in the Dvara research web portal. I guess after this session, we will share the link to the participants. One more or one or two questions also, like if you could able to. I know we are running with a short of time, but I guess this question also has some good essence. Like Dr. Warren has asked about the urban cooperative banking. Have you looked with the data and about the over indebtedness in UCBs? He has asked. And one more, sir has asked about, is the NSO data not sufficient for the analysis? So I guess you can, yeah.
Coming to the first question, unfortunately, Dr. Bhupesh, like we were discussing, we did not have an opportunity to go ahead and study the data. So therefore, we will not be at a position to comment on the features of urban cooperative banks at this stage. Once the data is out there, perhaps we can have this discussion, and perhaps we'll be in a better position to answer that. But coming to the next question regarding NSSO data, I think that's a very, very important question and a very pertinent question. It is true that in certain cases, NSSO data can help us. But the problem is that the data that NSSO captures, specifically in regard to household debt and household income, that happens at an annual cadence. Now, at a decadal cadence. That means every decade we are collecting that information. However, unfortunately, the credit cycles, for example, if you look at, say, certain loans, like, for example, microfinance loans, which are just of 2 years duration, there would already be 5 microfinance loan cycles before the data is captured. In case of India, if we look at the last 5 years, we have seen localized events like a cyclone, earthquakes, etc. We have seen demonetization. We have seen the COVID. So things that have changed the very paradigm of the economy. So therefore, it's difficult to rely on a decadal survey that happens every decade, and it's much more needed to look at more real-time indicators. In an ideal world, we would know what is happening at that very instance. However, that is, of course, a case of regulatory overreach and also impractical to operationalize. So therefore, for different indicators, different frequencies are proposed. But all of those frequencies have to be at the very least at an annual level. And if you look at that, therefore, while NSSO data will be able to provide us insights into the income, liability, assets profile of the borrower, it can at the same time not provide more nuanced information that we would need from the qualitative survey, which is regarding the experiences of the borrower. Like an NSSO data, for example, doesn't ask, in order to repay your loans, did you take your children out of school? That is the human experience that we believe that certain surveys will be required to capture. And we think that in the validation stage, such surveys will be very pivotal. And to answer the other part, it is, of course, because we will have more data and a more frequent data. The policy regime and the reflexivity of the regulatory regime will definitely be higher with at least an annual data collection.
Okay. And the last question from my side, then I'll hand over to Pranav. Do you consider lacking in the administrative system is more responsible for the deficit awareness about indebtedness in the Indian society than anything else? It's asked by Rohan Lande.
I think that's a very good question, and I think while we can definitely say that there is a lacuna because of that, policies to prevent over indebtedness are not optimally designed, perhaps. But these are all causal links which are probabilistic to an extent. Like we need to study the entire dynamics to understand what exactly are the driving features. But of course, that is one of those. But in addition, there are cases where at a business model level, a provider just does not want to go into analysis of debt serviceability. So for example, if you take loans against liquid security like gold loans or loans against shares or mutual fund units, they already have the comfort of knowing, providers have the comfort of knowing that in case of a default, you can very easily take the money and get the money. So in those sort of circumstances, you don't really rely on, or rather even go for a debt service capacity analysis. So we believe that these features must be there, that everybody should go for a debt service capacity analysis, and we should go ahead and monitor these things. In the end, one can blame the regulator for everything, that why did you not mandate policy A, policy B. However, we must understand that there is also the autonomy of the provider that must be preserved. And as the moment the autonomy of the provider is preserved, the provider may also take certain actions. So those actions can also lead to cases where there is over indebtedness. And apart from that, there can be instances or there can be issues at borrower level. So for example, you take a loan for a business and the business fails, unfortunately. And in that case, the over indebtedness is not caused either due to, say, a lapse at the regulatory level or at the provider level. So there are multiple features that can lead to over indebtedness. However, we do believe that policies to tackle that need to be better designed. And the approach through which such policies may be better designed is by understanding the problem at a better level. And capturing these indicators will definitely aid in that.
Okay. Thank you so much, Dwijaraj and Amulya, for the nice presentation and very well answered the all given questions. Now I'll hand over to the session to the Pranav Raj. Over to you, Pranav.
Thank you, Dr. Bhupesh.
Thank you so much. I just have one question before I conclude the session. So, Dwijaraj, in one of the slides, you mentioned about algorithms which are obvious to shock events. I just would like to understand a little bit elaboration on what exactly you mean by shock events. You have mentioned two examples there, and the other question that I have is, what are some of the suggested strategies to curb over indebtedness that you have mentioned in one of the slides?
So coming to the algorithms question, I think that's in the interest of time, I sort of skimmed over that slide, but that's a very pertinent question. So if you look at an algorithm, if the algorithm can basically track what is the evolution of DSR over time, how many new players have entered the market, what is the evolution of credit to GDP in a specific region. What the algorithm, however, cannot track or does not know is any information beyond the indicators. Such information would be, say, whether or not there's a pandemic that is going on. That information is not something we are reporting to the algorithm. So the algorithm, when it is measuring the entire, like let's take the case of a very simple regression. So when you're running the simplest regression, you will see a structural break in the entire regression line, because there is an event which is not captured by these indicators, and unless we map those events out, it will be very difficult for the algorithm's result to be accurate and pinpoint. So by shock events, we mean events like an earthquake, or events like a pandemic, or events like even a demonetization that can severely impact the economy and therefore the actors within the economy, namely the providers and the borrowers. And we believe that the algorithm therefore has the incapacity, or rather the inability, and this is unfortunate for every algorithm, to go beyond the set of inputs it's provided. So hope that answers.
Yeah, I just had a little doubt. Do we actually only talk about the natural calamities which can be understood as shocks, or there might be certain incidents which are very individual specific, but they can or they are still to be treated as shocks? Because borrowing or taking a loan depends individual to individual purpose, and how exactly such shock events are to be captured in the from the perspective of the borrower is not that clear. That's what.
Right. So you're right that yes, the shock events can be at a borrower level. However, the problem is the moment we start aggregating data at a district level, such shocks are not possible to be captured. Second, the visibility over such shocks rests only with the borrower, and even the provider doesn't know. So, for example, if there is the demise of someone in a household, or if there are some unfortunate medical expenses that are required, those are of course shock events at a household level, which will impact their cash flows and their debt serviceability. However, the moment we aggregate the data at a district level, A, they will not show up. B, such information is not even present with the lender, so they cannot report it. So that information is actually something which we expect to be captured as part of the borrower level survey, where we say that, okay, geography A, let's say some district in Delhi, has a lot of over-indebtedness, or the algorithm predicts that there's over-indebtedness. So we go and do a sample survey over there, or the RBI goes and does a sample survey over there, where you try to understand what are the primary levels of why exactly is there a distress. Is it due to some localized calamity that has happened? Whether it's due to, say, multiple cases of personal shock events or things like that. So the regulator is not well positioned, I would argue, to capture at that level. However, that is, of course, a level of analysis that would definitely enrich the system a little bit more. But we do believe that it's slightly unfeasible to do, because then you basically want the regulator to have an insight into every household at least a quarterly or a monthly or an annual level. So that may be slightly an overreach. In terms of policies that can prevent over indebtedness, so I think there are multiple policies that are already there in place. But if I can characterize them in two ways, one would be the policies that are ex ante, which is at the time of disbursement. We have to ensure that there are appropriate conduct guidelines. That's the provider conducts itself in a manner where it takes a fiduciary responsibility to ensure the well-being of the customer, and multiple other such conduct guidelines. This is actually something which we have written about in the past. In fact, the who introduced Dvara Research and is our Deputy Executive Director and Head of Strategy, has a paper on universal conduct guidelines, like what are the conduct guidelines that every provider should employ. So those are, for example, certain things that can be done at an ex ante level. We have also looked at, can we go and prescribe guidelines for credit appraisal so that we don't see the phenomena of subprime lending and other such issues where providers are going ahead and not measuring the capacity, debt serviceability of the borrower. So those are, of course, those are the ex ante policies that can be taken in play. Ex post policies would be to allow restructuring, to allow a little bit more customization of the loan products. It's feasible that the household may have very volatile cash flows. Like, for example, agricultural households, they have very volatile cash flows. At the end of the harvest, huge influx of cash. Rest of the period, you don't really see such an influx of cash. So in those sort of circumstances, customizability of product is an option. Similarly, ensuring that the insolvency and bankruptcy regime is something which is capable of taking care of debt distress, taking care of resolving such cases where restructuring or, say, an extension of loan terms cannot help. Those are the tools that need to be there. So there are certain tools that definitely need to be there, but we think that once we understand what are the primary levels of the problem and what is the extent of the problem, perhaps through the use of these indicators, perhaps the RBI will be able to better design its policies.
Okay, I think that was an elaborate answer. So once again, I thank both of you and Deepti ma'am as well for giving us your time and presenting this very informative and wonderful presentation. I hope many of us would take a lot out of this session, and thank you once again. And I'm also really sorry for the initial goof of it. It should not have been there, but once again, I thank all the participants as well for listening to Amulya and Dwijaraj patiently. We look forward to having such wonderful presentations in near future. So thank you, all of you, once again. Thank you, Bhupesh. Thank you, all other who have been part of this webinar directly or indirectly. So thank you once again. Thank you.
Thank you, Prathaman. Thank you, Dr. Bhupesh. It was a pleasure.
Thank you.
Thank you for now.
Bye.
Thank
Thank
you
you.
to everyone.
Thank you.